U.S. economic outlook. You'll be hearing from Greg Dacko and myself, Kathy Bosch-Jancic, on the U.S. economy, and particularly how the U.S. economy is going to navigate through the rough international seas. And after Greg's overview of the U.S. economy, I'll follow up with the Fed implications and implications for financial markets. We anticipate this will last about 40-45 minutes with the presentation, and we're going to leave time at the end, 20 minutes or so for questions and answers. And if you do have questions, please type them in the chat box at the top of your screen. So without further ado, let me hand off to Greg.
Good morning, everyone. I thought I'd start off with a quick overview of some of the main dynamics around the world. We're in a global economy that's being pulled in different directions, and the key central theme here has been what has happened to oil prices, with the oil prices falling about $50 or over $50 per barrel over the last 6 months. Looking at the different regions around the world, the U.S. economy is doing quite well, facing some of its strongest fundamentals in a decade, and expected to accelerate quite sharply in 2015. But across the pond, the news is more mitigated. We have seen the Eurozone being supported to a greater extent by a new QE program from the ECB, which is a massive shift in the ECB's policy, and we're also expecting gradually stronger growth, but the momentum will be far from what we're seeing or expected to see in the U.S., and there are major risks, including Greece right now and the ongoing tensions between Ukraine and Russia. In the other developed countries, we're seeing also modest news, modest evidence of growth. The latest numbers in Japan are somewhat mixed too. We're seeing a very slow pace of growth in Japan, and the monetary stimulus is having some effects, but have been partially offset by the fiscal arrow, which implemented a tax hike for consumers in the early part of last year, and which led to another recession in Japan. In the BRICS, we're seeing, again, mixed evidence. In Brazil, the news is not so good, with growth flirting with zero, and the economy struggling to really make much progress without the benefit of higher commodity prices, and significant structural issues impeding growth in Brazil. In China, we're seeing an ongoing slowdown of economic activity, and although the official readings still show growth around 7.4, 7.3% year over year, our alternative economic activity indicators point to much more subdued growth, and we see the momentum going forward for China to be on the downside. And meanwhile, India, we're seeing some good signs, favorable signs for growth, although the latest numbers pose some questions as to the credibility of the growth estimates that were revised up more than 1% and show very, very strong growth now in India. But still, the momentum is up, and the fact that oil prices have fallen allows for a little bit more flexibility for the central bank to lower interest rates, with inflation being less of a constraint. Now, I mentioned oil prices at the beginning, and I think it's important to reflect a little bit on the oil price situation. We have seen a very, very sharp decline in oil prices. A number of different factors have been behind this decline. Basically, it started with a disconnect between demand and supply. We saw weaker global demand, and the IMF estimates that that component is about 30 to 35% of the explanation behind the fall in oil prices. But on top of that, you've had continued increases in supply from the U.S., from Canada, non-conventional oil there, but also in some of the traditional oil producers from the OPEC, including Iraq, which saw big increases in production. So the combination of a lack of adjustment of supply and relatively sluggish demand led to the initial decline in oil prices. On top of that, you had the fact that OPEC and, importantly, Saudi Arabia decided to no longer act as a swing producer, and decided that it would rather protect market share than risk losing market share by cutting production in the face of these declining prices. And so that leaves us with a somewhat much different picture in terms of oil prices. Oil prices currently trading around 50, just under 50 more recently, and questions as to how this will affect the various economies, the various regions around the world. Overall, we see this as a net plus for global growth, but there will be some major distinctions between net importers and net exporters, Russia being the key example of a country that has a lot to lose from much lower oil prices, but also the OPEC countries would be big losers. Is there a potential for prices to fall lower? Potentially. On the left-hand side here, I graphed the estimates from the International Energy Agency of supply and demand, and you can see that in the first 2 quarters of this year, we're still expecting a relatively large accumulation of stocks, oil stocks, which could eventually put further downward pressure on oil prices. But we do expect a gradual adjustment of production, importantly in the U.S., with oil rigs, the number of oil rigs falling quite sharply and investment plans being cut. That should lead to lower oil production in the U.S. and put some upward pressure on prices, and we do also expect some reaction from OPEC members. What's going on in Europe? Well, I mentioned at the outset that the ECB finally implemented a QE program with the decision to buy sovereign bonds on top of the decision that they had made a couple weeks prior to buy asset-backed securities and covered bonds. The idea being to bring back the ECB's balance sheet back to where it was in 2012. So that's about 1 trillion worth of euros in purchases over the next year and a half or so. That's a massive program. That's a massive shift in the ECB's stance, and we believe that will have an impact on economic activity and growth in Europe, and we do expect that this will contribute to the economy accelerating. So if you combine the fact that we have a boost from lower oil prices and the fact that we have this now massive QE program, that should help Eurozone accelerate to above 1% this year, and gradually, though slowly still, making its way towards 2% in the next coming years. Those are the positives, and I have to add to that the fact that the euro has depreciated quite sharply. That means a boost to export competitiveness for Europe overall. It also means that that will then generate stronger business investment in return and boost the European economy further. There are still some major issues, though, in Europe. High debt, major structural issues in terms of labor market flexibility and other structural issues. But the momentum seems to be up. The wild cards, I listed them here, are Greece and Ukraine, although we've seen negotiations work in favor of a ceasefire in Ukraine in the last couple of days, so that situation might improve. The big question is what will happen to Greece and what will be the outcome for Greece, but also for the rest of Europe when it comes to that situation. Now, turning to BRICS real quick. In China, I did mention a massive slowdown that is expected in the coming years. We are still, as I mentioned, seeing official data, official GDP readings above 7%, but we estimate that growth is probably under 7%, probably more around the 6% pace. And we expect that this momentum will continue to slow as we grow forward. In China, you're seeing an environment in which there was massive excess investment, and as the economy is gradually shifting away from that export and investment-led growth model, we're expecting a slowdown of the economy. I've pasted here a chart that illustrates comparisons of China with Korea and Taiwan, which were both facing similar situations in terms of investments as a share of GDP, followed by somewhat steep declines in the pace of investments as a share of GDP. In India, we're seeing favorable evidence in terms of growth, and the fact, again, that oil prices have fallen have put downward pressure on inflation, though there are still major structural issues, including lack of infrastructure and supply bottlenecks. But despite that, we're seeing downward pressures on inflation, and that leaves a little bit more leeway for the central bank to lower rates and to stimulate the economy. In Brazil, big questions as to what will happen in the coming years. The recent re-election of Rousseff and the appointment of a new finance minister are good signs. They probably mean some transitions in terms of policy for Brazil, but still we're seeing weak fundamentals for the Brazilian economy, and we're not expecting very much growth in the coming years. So turning to the U.S., the U.S. has seen a relatively disappointing year if you look at it from a global perspective, the year overall. In terms of growth for the year, we saw average growth at 2.4%, but it was a highly volatile year in terms of growth rates. So here I've pasted in light blue our December 2013 forecast and the actual numbers for growth. And we had expected a gradual acceleration of growth going forward, which with wage growth finally picking up and providing a stronger boost to the U.S. economy and to consumer spending, importantly. What we saw was somewhat different, with a sharp decline in real GDP growth in the first quarter, followed by two very, very strong quarters. But both of these, the first one was a rebound following the hit to the first quarter, but the second was also driven by government spending, a surge in government spending, and some net trade elements that worked favorably for the U.S. economy. I think the fourth quarter is probably the best indicator of where we currently stand in terms of growth. So with growth, just around 2.5% and gradually accelerating to 3%. And I'll tell you why in a second. I think that growth is going to accelerate to around or above 3% potentially in 2015 as we look through the different elements that are supportive for growth. This is one of the key elements that's very, very encouraging. We've seen very, very strong payroll growth, very, very strong employment growth. The last few data points are extremely high. We've seen readings in November. We saw a reading over 400,000 jobs added for the U.S. economy. And the last couple of readings were both over 250,000 jobs. So the average over the last 3 months is very, very high, and even the 12-month trend is around 260,000 jobs added on a monthly basis. This is extremely strong for the U.S. economy, and I often tend to say it's not worth looking at the monthly data so much because it's quite volatile, as you can see on the red bars, but still here there is clear evidence looking at the 12-month moving average, the green line here, that the momentum is up. We do expect somewhat cooler job growth in 2015 compared to 2014, but still the momentum is strong, and we expect that will support ongoing advances in consumer spending in 2015. And the news is quite good all around. If you look at the unemployment claims, they've maintained under 300,000 in terms of initial claims for unemployment, and even the 4-week moving average has remained around that 300,000 mark, which would be in line with payroll growth around 200,000 on a monthly basis. So still good signs in terms of companies laying off. And we're seeing also very encouraging signs in terms of the unemployment rate. If you look at the unemployment rate, it has fallen quite dramatically over the last few months and is approaching right now what could be considered the NAIRU, the non-accelerating inflation rate of unemployment, or in other words, the full employment unemployment rate. So very, very encouraging signs in terms of both how many claims we're seeing on a weekly basis, but also the unemployment rate. And that bodes well for continued gains on the employment front. Beyond that, we're also seeing good evidence when it comes to labor market dynamics. We're seeing the quits rate continuing to rise, and that's a good sign. It's not a bad sign. It's actually a sign that individuals are more likely to quit their job and try to find a better opportunity. So it's a sign that there are opportunities out there and that people are actually ready and willing to take the risk of quitting one job to go get these better opportunities. And we're seeing that also in the number of hirings and number of openings for the U.S. economy, both recording post-recession highs and very strong numbers in the last few readings. In terms of the employment to population ratio, we're also seeing ongoing improvements, and that's a sign that more and more people are finding jobs, and very encouraging overall for the U.S. economy. And that's translated into strong consumer sentiment and strong consumer confidence. Both indices have been continuing to rise strongly over the last few months. Now, I've circled two things here. The box on the left-hand side shows you the average over the 1985 to 2007 period. And the round element here shows you the spike in the last couple of months. Now, is it due to employment? Yes, I think in part we're seeing the reflection of stronger employment growth in consumer sentiment and consumer confidence, but it's also, and very, very importantly, the reflection of the drop, the massive drop in gasoline prices. Those are a key factor in boosting up consumer confidence, because when you when the average person is driving around and looking at the big billboards that show the oil prices, it sees that oil prices are now, or gasoline prices are now, either at $2 or even under $2 in some places, and it remembers that 6 months ago they were more than $1 higher than that. So that's a big boost to confidence, and it means more money in people's pockets. We've actually calculated how much it means for households. Assuming that oil prices, that gasoline prices, had been at about $3.50 per gallon in 2015, and assuming that they maintain themselves around $2 per gallon in 2015, then the difference in gasoline prices means about $1,400 per household in each household's pocket. So that's a significant boost to the income of each of these households. And importantly, and I think this is very important to note, it's not as if you receive this check all at once. It's a gradual check. So it's as if you, did not have to spend as much money each time you filled up your tank. Why is that important? Well, because it likely means that these households are going to spend a large share of that oil or gasoline bill saving. If you receive a large check of, say, $1,400, you're likely to put some of that aside. If you, on the contrary, receive $20, $15 each week when you fill up your tank, you're more likely to spend that. So that's a big plus potentially for the U.S. economy. Now, what will that mean in terms of inflation, these lower gasoline prices? Well, we expect to see a negative CPI reading towards the middle of this year, most likely around June, July, maybe a couple even of negative readings. Now, is disinflation bad for the U.S. economy? Well, we couldn't get Tom Brady here to talk about disinflation, but I think it's important to note that it's very, very different from deflation. So in terms of what this means, it means lower prices, but it doesn't mean lower wages and a negative spiral in which prices are continuing to fall month after month and wages are going in the opposite direction, not up but south. And why is that important? Well, it's important because in a deflationary environment, you tend to postpone your purchases because your dollar today is going to be worth more tomorrow, and tomorrow, again, it's going to be worth the day after. So you tend to delay your purchases. That's negative overall for the U.S. economy. On top of that, the real cost of debt usually tends to rise in a deflation environment. That's very, very different from a disinflationary environment in which, yes, the headline CPI might temporarily go down to 0 or under 0, but the core prices, importantly, are maintaining their head above 1%, and wage growth is accelerating. And that's overall a good environment because if wage growth is accelerating in a relatively muted inflationary environment, that's positive for consumer spending. So what are we expecting in terms of wage growth? Well, we're expecting a gradual acceleration in wage growth. We've seen it in the monthly data. We've seen a relatively important rise in real average weekly earnings. Now, granted, a large part of that might be due to the fact that we actually have lower inflation and negative inflation, so the real wage growth is accelerating faster than the nominal wage growth. But still, we're gradually seeing more and more evidence of rising earnings, hourly earnings. We're gradually seeing stronger evidence in terms of the employment cost index, and all those elements are favorable. Even if you look at the National Federation of Independent Businesses Small Business Optimism Index, and you look at both the share of companies expecting to raise wages, but also, importantly, the ones that have raised wages, both of these are trending up. Now, on a monthly basis, they might go up and down, but the trend is clearly up, and we expect that this is a clear sign that wage growth is going to accelerate in the coming months and in the coming year, and that will support stronger consumer spending in 2015. So what environment will we have for consumer spending? Well, we expect, we called it DISCO, depressed inflation and strong consumers. Very strong consumer spending, especially with regards to the last few years. We're expecting consumer spending to outpace 3%. And meanwhile, headline CPI, as I showed, is likely to be restrained. Again, it's not an environment in which we're seeing slow growth, which leads to low inflation, but on the contrary, the low oil prices are boosting consumer spending, but also deflating inflation. And that's overall a positive element for the U.S. economy. Are there constraints on the U.S. economy? Yes, I think there are still some constraints. I did talk about the fact that overall the labor market was showing very good signs, but we're still seeing a high number of discouraged workers, especially with regards to the long-term average, and marginally attached workers. So both of these components are still lagging behind, and we have yet to see more of these people coming back into the labor force and leading to a gradual rebound, or at least, minor rebound in the participation rate. That is something that we do expect to happen, but it will take time, and it's a gradual process. And I was mentioning the fact that we do expect stronger wage growth, but the evidence is still, somewhat mixed. Yes, we are seeing gradual improvements in wage growth, but as I mentioned, this was a disappointing element for 2014. And probably one of the main reasons why growth wasn't stronger in 2014 was the fact that in 2014, we were still missing some of that wage growth, and we expect that to come into place in 2015. The other element that's a key constraint on economic growth is the fact that we've seen relatively sluggish housing activity. Now, that's no surprise. The slowdown started around mid-2013. It was exacerbated by the polar vortex and the fact that we saw really poor weather in the first quarter of 2014. But then, since then, over the course of 2014, we saw relatively muted growth on the housing front. Here I've highlighted single-family housing permits. They tend to be forward-looking, less volatile, and immune to weather. And they were relatively sluggish over the course of 2014. But we do and are starting to see somewhat of a rebound in that category. And that's encouraging because it means that some of these first-time home buyers are coming back into the market. It's a gradual comeback, and probably one that will continue to be gradual as people tend to want to save a little bit more, put more money aside, and make sure they have stable finances before they actually take out a loan for a new home. But we are starting to see some evidence of a rebound in single-family permits, and that's quite encouraging for the U.S. economy. And it's reflected in part by the fact that we've continued to see an improvement in the different determinants of housing affordability. So you can see here that mortgage rates have fallen quite sharply, and they're close to where they were at the beginning of 2013. And that's a good thing. We're also seeing that being reflected in refinancing operations. But overall, that's a good sign because it means that it's now cheaper, again, cheaper than it was a year ago or even a year and a half ago if you want to purchase a new home. Importantly also, we've seen a moderation in home price inflation, and that's also key because some home price inflation is good because it makes people more active in the housing market, but excessive housing inflation in an environment in which wage growth is still somewhat subdued is not good for the housing market. So we're again expecting gradual acceleration in wage growth and relatively subdued home price inflation and reduced interest rates, mortgage rates, to combine to limit the downside to housing affordability and push more people into the housing market and expect a gradual rebound of housing starts, ending the year probably around 1.2 million units when it comes to housing starts for 2015. And that's going to be supported to a large extent also by the fact that we have pent-up demand on the housing front. Here you can see the household formation rate, and you can see that the number of new households being formed over the last few years has really disappointed. There are some cyclical factors to that, but there are also probably some structural or delayed cyclical, as Kathy will highlight in a moment. But we do expect that the accumulation of the pent-up demand will gradually be released in this environment of low prices, moderate interest rates, and rising wage growth to support stronger housing activity. And on top of that, we're seeing banking standards for residential mortgages loosening. They had tightened very, very sharply during the Great Recession, and then for the few years after that, they were roughly neutral. And now we're starting to see somewhat of a trend of loosening standards for residential mortgages and different programs being put in place by the administration to try to boost housing activity. Now, what's going on the business front, and how are we seeing the next couple of quarters, the next couple of years when it comes to business investment? Overall, this trend seems to be solid. We're seeing industrial production continuing to rise at a solid pace, around 5%. We're seeing capacity utilization not too far from its long-term average and close to its pre-recession level. We're seeing good signs when it comes to the leading indicators from the ISM manufacturing sector. Even the non-manufacturing sector ISM readings have been very strong, and the new orders, the production, the employment in both of the indices, forward-looking indices, have been quite strong. So that's very encouraging when it comes to business investment. That being said, there are some risks to the downside. The strong dollar and the sluggish growth environment can weigh on business investment, and that is a key risk that we see to our forecast. We saw the latest durable goods numbers in December, which were disappointing, and you can see here I've circled that point. It somewhat stands away from the trend. The shipments data was still quite encouraging, but the durable goods orders were a bit disappointing, and there are some worries that a weaker global environment and a much stronger U.S. dollar could weigh on capex going forward and on U.S. exports too. So we've taken a look at the different elements of this picture, both in terms of what oil means for the U.S. economy, but also what the U.S. dollar means for the U.S. economy. And in terms of oil capex, well, it's going to be a net plus for the U.S. economy in 2015 because the boost to consumer spending is much, much larger than any of the other drags. That being said, there are some negative effects potentially for the shale sector when it comes to business investment. And we looked at two scenarios, one where oil prices average about $55 per barrel, which is our baseline scenario. And we noticed that in that case, if you look down at the right-hand side at the table, the net plus to the U.S. economy is about 0.4 percentage points. But there is a drag from lower capex of oil capex of about 0.1 percentage points. And how does that all fit in together? Well, consumer spending, we highlighted that lower gasoline prices put more money in people's pockets. They're likely to spend that savings, and that boosts consumer spending by 0.9 percentage points. Business investment, in turn, is stimulated by the fact that there is stronger consumer demand and the fact that input costs have fallen, but there is a negative effect from lower oil capex. Now, the negative effect is relatively small, and you might be wondering why. Well, despite all the hype around the unconventional energy boost, oil capex in 2013 only represented about 4% of total business investment and only about 0.5% of GDP. So it's a really small share of the economy. So the net boost to consumer spending much outweighs the net drag to oil capex. That does not mean that some regions will not be affected very severely. Regions that are heavily focused around oil will no doubt be impacted, but overall at a national level, the impact is relatively muted. Now, I did highlight some other components in terms of trade. I put a negative for trade. I think, yes, you get a boost from the fact that oil prices are lower, so your oil import bill is lower, but at the same time, reduced domestic production and strong consumer spending will likely mean that you have to import more, and that puts a drag from trade. In terms of global growth, modest and sluggish global growth likely to weigh on U.S. growth, and the stronger dollar I'll highlight in more detail in a second, but we estimate that about a 10% appreciation of the U.S. dollar has a negative drag effect of about 0.3 to 0.4 percentage points on the U.S. economy. I highlighted another scenario, and I'll go through that really quickly, of oil prices falling under 50 and remaining there, and that's important, remaining under 50. I think that could then have a much larger drag on the U.S. economy. And although it's very hard to calculate the national break-even price because there are so many break-even prices for shale oil, if oil prices fall under 50, I think that could then turn into a much more severe scenario for oil capex and have a much larger drag and implication for real GDP growth in the U.S. And what about the U.S. dollar? Well, we're looking at a number of different pieces on the U.S. dollar, but our main conclusion is that basically the fact that the dollar has strengthened quite sharply. On the right-hand side, you can see about 20% against the euro, more than 15% against the yen, around 12–13% against the pound. All those elements mean that this will weigh on U.S. export competitiveness and, in turn, export growth and then business investment for the U.S. So that's a net negative for the U.S. economy. This has to be put, though, into context. The U.S. dollar historically was relatively competitive. If you look at the blue line, the real trade-weighted broad index from the Fed shows that the U.S. dollar historically was quite competitive, cheaper than it was on average since 1980, cheaper than it was during the early part of the 2000s, but of course much more expensive than it was in the month and in the couple of years prior to this recent surge. So yes, the surge in the dollar is going to hurt the U.S. to reduce export competitiveness, but at the same time we're starting from a relatively competitive starting point, which means that the impact will likely be less important than if we had started from an already very high and very expensive U.S. dollar. Overall, in terms of growth impact, I mentioned about 0.3 to 0.4 percentage points is expected in 2015 from the 10 to 12% appreciation in the U.S. dollar. And I wanted to conclude with what's going on the fiscal policy front. Basically, yes, we do have a new Congress, but we have the same old issues. Very little or low probability of much passing through Congress and through the president after that. We expect an environment in which we have ongoing low deficits. The debt to GDP ratio is expected to stabilize around 75%, probably rise in the second part, in the second part of our forecast, which is a 10-year forecast, so in the 20 to 24 period, as the deficit once again starts to rise, because even though the deficit has fallen quite sharply on stronger revenues, on less public programs, there is still this big and important and delayed issue of the entitlement spending and spending on Medicare, Medicaid, Social Security in a population that is aging quite rapidly. With regards to the short term, the debt ceiling would be the next big hurdle, but we believe that this debt hurdle, which should be March 15, theoretically, could be delayed to the fall of this year. Why? Well, in theory, the debt ceiling will be raised to whatever level the debt is on the day before March 15th, but then there are some accounting maneuvers that have been used in the past, and the fact that April is a very strong revenue month, the combination of both of these elements could push the deadline into the late summer or early fall. And to conclude, I think that we're expecting to see growth, real GDP growth around 3.1% in 2015 and around 2.8% in 2016. The fundamental driver of this growth will be stronger wage growth combined with ongoing payroll growth, relatively low inflation, and modest interest rates. And we'll go into more details with Kathy. Thank you.
Thanks, Greg. So that was a great detailed look at what's going on in the U.S. economy and also the international cross currents. And I guess the question is, when you think about the Federal Reserve, is what are they going to do amid all these macro cross currents? How patient will they be in initiating interest rate liftoff? And in other words, you could say, how patiently will Yellen and others be in waiting to see the whites of the eyes of inflation, or, because that's Larry Summers, former U.S. Treasury Secretary, has been out saying that they should wait, or will they continue to look through the weak inflation readings that we've seen and attribute it mainly to transitory factors such as the lower in oil and stronger dollar? and also recognize at the same time that the labor market is really heating up. What's the impact of the stronger dollar that Greg highlighted and have an impact on monetary policy? And then beyond the initial rate liftoff, what does the trajectory of interest rates look like? So let me just first give a couple different takes at what's happening in the labor market, and particularly wages. We do think, as Greg said, as wages are poised to rise more meaningfully, but I think it's instructive to also decompose the unemployment rate and look at it different ways and match it up against wage growth. So here I have the overall unemployment rate that we're used to seeing each month. I subtracted what is known as the long-term NAIRU rate, which is non-inflationary inflation rate of non-accelerating inflation rate of unemployment. And we're typically in line with what the Congressional Budget Office thinks, that again, somewhere between 5 and 5.5% on the unemployment rate represents full employment in the labor market. So the red line, it's inverted, but what you could see is the difference between that, the published, and this NAIRU rate, that we're really closing the gap, that we're getting pretty close to what historically has been seen as full employment in the labor market. When that's happened previously, we've seen wages pick up quite noticeably. Of course, this time there's been quite a bit of a lag, which is the blue line, that's employment cost index, and that's the core private wage and salary component. But it is picking up modestly. So if you looked at the beginning of the year-on-year rate was around 1.7%, and now we're at 2.2%. So it's very modest, but again, it is lagging. Another way, if you dig deeper beneath the headline unemployment rate, you could separate what's short-term and long-term unemployed. If you look at just people who've been unemployed 26 weeks or less, so 6 months or less, that's the red line, and you compare that to a 20-year average, and you see that the short-term, the dynamics in the short-term unemployed labor market, and actually that cohort's back to normal. If anything, people who've been unemployed a short period of time and a really big high demand, they probably have the skills that are in demand, and maybe there's other various reasons, bias as well, but you can see that they're hired rather quickly. In fact, if anything, there's a tightness in that part of the labor market. The long-term unemployed, the picture's a little bit different. That's the blue line, and that's where a lot of the debate, of course, has been. Janet Yellen and others who are considered more dovish on the FOMC would argue, well, because so many people have been unemployed and relative to average, and we still have a lot of excess slack in the labor market, so we're far above what the 20-year average would be. So that's true, and then the question is how much downward wage pressure and headwinds is that exerting? Maybe another way to look at this, too, though, is to look at a broader measure of unemployment. So instead of looking at the U3, which is the published unemployment rate, we can look at what's called the U6 from the Bureau of Labor Statistics. And that includes all marginally attached workers, people who are working part-time would rather work full-time, discouraged workers. And there you'd see, again, it's still far from what would be considered normal in that part of using this measure for unemployment. And there's still a wide gap, meaning there's a lot of excess slack, a lot of people who are not yet fully employed in this economy, and that's the red line. At the same time, even this measure has improved quite dramatically. And I think this is, again, good news when you look at all of the labor market and the growth that's been in terms of jobs. We're really seeing a labor market that's really heating up. We've been, you look at the employment to population measure, it was rather stagnant from 2010 to end of 2013, but what we really saw was a breakout in 2014. And I think as time goes on, we'll narrow this gap, and we'll start to see the blue line, which is wages and salaries pick up. And again, as Greg had highlighted earlier, we like to look at some of the leading indicators of wages, and one is the NFIB Small Business Survey, and they do ask companies, do you plan to raise your wages in the next 6 months, and that's the red line. And you can see that it has a pretty consistent and reliable two-quarter lead on the private wage and salary growth. So again, it gives us, along with all the tightening in the labor market, job openings picking up, job growth, it does give us encouragement that we are going to see wage growth pick up gradually but pretty meaningfully in 2015. Now, that's one part of the dual mandate that the Fed has, so they want to reach full employment. The other part is achieving a stable 2% inflation rate. It used to be that the Fed never actually came out and had an explicit target of 2%. It used to be just low and stable inflation that doesn't adversely affect business conditions, decisions or investment decisions. But a few years ago, with Bernanke's urging, they actually adopted a 2% inflation target. We've been woefully below that target on the headline number, and even the core, when you strip out food and energy, has really struggled to get to 2%. Now, more recently, the steep drop in oil prices has certainly taken the headline inflation number down. It's not just the inflation numbers, but it's also inflation expectations that Fed policymakers are concerned about, because expectations become a self-fulfilling prophecy. What you expect prices to be has a real direct and meaningful impact on what they'll actually turn out to be. And that's why they watch inflation expectation measures closely. And in the market, there's a Treasury inflation protected securities called TIP securities, and you can pull out what the break-even or what the expected inflation expectations are, and they've just plummeted. So as oil prices have fallen, you've seen the 5-year inflation expectation and also the 10-year inflation expectation in the bond market collapse. But I would argue that this is really driven by oil, and again, can largely be temporary. If we settle in at $50, $55, these both the inflation measures but also inflation expectations should settle down. In fact, if you look further out and you strip out between 5 years and 10 years from now, so it's what's called the 5-year forward inflation expectations measure, that too has declined, but it's much more anchored. And there it's still roughly around 2%, which again gives the Fed some comfort that inflation expectations haven't meaningfully dropped. The other set of inflation expectation measures that they'll look at are consumer expectations and also professional forecasters. And again, there they've been relatively stable, whether you look at the Conference Board, University of Michigan, and for professional forecasters, something called the Livingston Survey, have all been relatively stable. Again, good news for the Fed if they're starting to think about initiating a rate hike. So they need to weigh both of those. The other part of the equation, too, has been the stronger dollar. On a trade-weighted basis, has appreciated more than 10%. And going forward, we expect another 6% or so appreciation in 2015. That certainly is a headwind for the U.S. economy and also could slow down the pace of interest rate hikes, because as the dollar strengthens, that does some of the tightening. It actually starts to tighten things in terms of inflation or put downward pressure on core inflation, and again restrains the economy. So it could, as that's tightening, the Fed may start to ease up a little bit on its pace of interest rate hikes. And indeed, the markets have reacted to that quite strongly as we've seen the dollar appreciate. Interest rate expectations have been paired dramatically over the last 6 months or so. More recently, though, we did see a pickup in the market's expectations of interest rates and also the timing of liftoff, and that came on the heels of the employment report that's almost 2 weeks ago now. Here I just illustrate what is the market expecting. So you'll see the first column, that's the euro-dollar strip curve, or in other words, the futures curve. And here, what is the expected Fed funds rate or short-term rate at the end of each year, 2015 and going out to 2019. And so the market is pricing in a liftoff for this year. But again, it's a rather subdued profile. It takes until the end of 2018 to get close to 2% on the Fed funds rate. You contrast that with the middle column, which is the Fed's median estimates as part of their dot plot estimates. And there you'd see that the median estimate thinks that the funds rate will be They're close to what they think is the neutral rate, about 3 3/4 by the end of 2017. So there's a big disconnect between what the median forecasters on the Federal Open Market Committee are expecting or forecasting and what the market's expecting. Now, in all fairness, and the market's not just looking at the median, they're trying to figure out where does Yellen and the other dovish members of the FOMC, particularly Yellen, lie on the range of forecasters. And no doubt she's a little bit lower than the median estimate, but still certainly not as low as what the markets are pricing in. And then the last column is our updated interest rate profile. We did pare back our expectation for Fed rate hikes. As I said, the stronger dollar, we think, does play more of a role as it hurts exports, it hurts earnings, corporate earnings as they're repatriated back into U.S. dollars, and it tamps down a little bit, or at least provides a lid for core inflation. But again, you'll see our rate forecasts are still meaningfully higher than what the market's expecting. We do think the interest rate liftoff starts in September. Previously, we had June, and to be honest, right now, the odds between June and September are looking quite close. The employment data were strong, and it could be that we get a signal from Janet Yellen. I think an important testimony to watch is on February 24th when she delivers the semi-annual address to Congress. And then that will be a signal as to what they're going to do with the March statement and how they plan to change their language and guidance. The other variable here as part of the cross currents is that, as we highlighted, the ECB is easing and engaging in massive quantitative easing. Also, the Bank of Japan. And if you look broadly across the globe, you have many interest rates are actually in negative territory. So you've got global investors searching for yield, and the U.S. Treasury looks pretty attractive, especially now that rates have backed up close to 2%. So that actually, ironically, will help keep some downward pressure on long-term interest rates in the U.S. So we're going to see continued strong foreign capital inflows that will limit how much rates go up in the long end of the Treasury curve. And because of that, and for a brief period of time, we actually saw interest rates lower at the long end. That actually offsets some of the negative impact of the stronger dollar. And here's just an illustration of one channel by which that can happen is through the housing market, and particularly refinancing activity reacts very strongly when mortgage interest rates drop, which is the red line. You see the immediate response at people going in and refinancing and saving real money on their monthly payments for housing. So along with the lower oil prices, that's extra money in people's pockets. And I guess with that, we'll leave it to see if we have any Q&A.
Yeah. Thank you, Kathy. We have a couple of questions. So here, just to illustrate what we have on the display here is our latest forecast for real GDP growth and the different components of growth. We have a couple of questions. One is a bit technical, but it's asking why the years for each of the graphs are different. Basically, I mean, we try to illustrate different points through all the different charts, so we try to focus on what we think is the most relevant, and that might either mean having a long-term chart or a very short-term chart or somewhere in between. So that's the reason for the different samples in the different charts. We had another question with regards to slide 21, where I illustrated the different components of growth and the effect of the oil price decline on the U.S. economy in 2015. And the question is with regards to the rest of the world, being a drag on the U.S. economy. In an environment, and the question is, well, in an environment in which you said that oil prices would be a boost to global growth, why are we seeing a drag here to global growth? I think here it's important to distinguish two things. It's important to distinguish growth with the U.S. and without the U.S., and it's also important to distinguish the timing of these impacts. In an environment in which we do and are seeing $55 per barrel as an average for 2015, that's, as I highlighted earlier, likely the consequence of sluggish global growth. So that's the first element. And that's also true without the U.S. And I think it's important to highlight that it's without the U.S. that we're really focused on right now. Yes, we are going to see a net boost from these lower oil prices, but what kicked this off is relatively sluggish global growth excluding the U.S., and we're continuing to expect relatively sluggish global growth excluding the U.S., and that's a net drag for the U.S. economy. Now, if you bring in the U.S. economy on top of that, yes, you have a strong domestic economy, yes, you have very strong fundamentals, and yes, you are seeing a relatively important boost to real GDP growth in the U.S. that then, as the U.S. is a large share of world growth, feeds into stronger world growth. So it's a question of factoring in the U.S. and the timing. I think that, yes, by the end of this year, we're likely going to see a net boost from growth excluding the U.S., but initially the effect is more of a drag. We have another question here with regards to the Fed. We mentioned that, Kathy, we pushed back the rate hike from June to September, but you also highlighted that the latest employment data was quite strong, and there is a question of whether Yellen will focus more on the labor market or on inflation. Some at Summers have said, we should wait until we see actually stronger inflation environment. The question pertains to what do you think will be the most important driver as to the rate hike from a Fed's perspective?
Yeah, that's a big question, and I think from the Fed's perspective and what they've been telling us, it's been pretty clear is that they're going to look through the weak oil numbers and weak inflation numbers. So they feel that the sharp drop in oil, no doubt, has weighed on inflation, and also the fact that we have a stronger dollar that, again, pushes some downward pressure even on core inflation. But it is hard to justify, I think, for many Fed officials keeping at the zero lower bound. Remember, we've been there for 6 years, and to stay there when we're seeing such strong labor market readings, and it can come quickly that, again, what we expected gradually, but wages will start to rise, and the Fed does not want to find itself massively behind the curve. And keep in mind, even if they lift rates, twice or 3 times, even if they went that aggressively for 2015, you're still going to have extremely loose monetary policy. So it's tighter relative to where we've been, but if you think the neutral funds rate is 3.75, even once they get to 1%, that's extremely accommodative, and the Fed has to weigh that. And as you showed, Greg, earlier in the chart, is that if oil prices settle in at some point here, you're going to start to see headline and even core inflation readings start to move higher. So that's why they think it's, at this point, transitory.
And a follow-up question on that with regards to the exchange rate effect. The question is, with the U.S. dollar having surged quite strongly over the past few years, some are questioning whether the Fed will factor that into account when it comes time to tighten, and whether a stronger dollar might actually delay or cause a delay in the Fed tightening. Do you think that's something that the Fed will pay close attention to?
Yeah, no, definitely the strong dollar is on their radar screen. I think right now the markets have priced in Fed tightening. Again, it could be June, it could be September, but they're starting to price that in more meaningfully, and that's why the dollar has strengthened quite a bit, along with the fact that ECB has done a massive QE. So I don't think it delays the rate liftoff, but I think as we get through go through 2015, but get into 2016, I think then that you're going to start to see the Fed assess a little bit whether they can actually do the pace of rate hikes, which the median estimates suggest. So again, let's listen closely to what Janet Yellen says on February 24th. I think that's going to be a very key testimony.
Thanks, Kathy. Another question we just had was with regards to the employment effects of the decline in oil prices on the shale oil sector, and the question is, what is in, well, will the plunge in oil prices slow down employment? I think the answer is yes and no. It really depends on what you're talking about in terms of employment. If you're talking about at a national level, the answer is no. The share and the size of the employment sector for the oil, well, even oil and gas is very, very small compared to the total effects. We looked back at the effects of the unconventional energy boom since January of 2010 and tried to look at how many new workers were added in the oil and gas extraction industry, and that's about 60,000 workers overall, which is a very, very small share. Now, I know there have been numbers boosted that, well, the unconventional energy boost added 1.5 to 2 million jobs in the U.S. economy since 2008. Now, maybe that's true, but that's not direct jobs. That includes indirect jobs, so support activities, but also very, very importantly, induced jobs. The way you get to those big numbers is by saying that the fact that we've had a large energy boom in the U.S. Has constrained oil prices and thus prevented higher oil prices from impeding economic growth and thus boosted employment relative to an environment in which oil prices had been higher. Now, if you take the current environment in which oil prices are much, much lower, yes, you're going to have some cuts in the oil capex sector and some supporting activity. So, yes, you're going to get somewhat of a drag. But overall, the fact that you have much lower oil prices is a net boost to the U.S. economy, is a net boost to consumer spending, and in turn is a net boost to employment. So we're actually seeing a net positive at the national level. And if anything, once prices start to go back up, the induced effects will be negative on the U.S. economy. So it has to be contrasted whether you're looking at specific regions within the U.S., specific states, or whether you're looking at the national picture, and whether you're looking at an industry or, again, at the national picture. One more question we had with regards to expectations for wage growth. I highlighted during my section that wage growth had been disappointing in 2014 and that it was going to be a key player, a key driver of growth in 2015. Kathy, do you expect, what are your views basically on how wage growth is going to evolve in the next coming months, and how do you see that playing a role in the Fed's decision to hike rates? Because you mentioned that inflation or low inflation was transitory. How does wage growth play into that whole picture of the Fed decision?
Yeah, so all the labor market indicators suggest that we should start to see wages pick up, and particularly if you look at the anecdotal survey from the small business survey, and their wages are already picking up. And in some sectors of the labor market, there's pretty severe labor shortage of certain skilled workers. I think that deepens and broadens, but I think overall we're going to start to, at the same time, see gradual increases, because we still do have a lot of excess slack in that the amount of people who are underemployed. But if we start to get, another way to think about it is you could go from 2.2%, you start to get gradually rise to 2.5%, somewhere between 2.5% and 3%. That's a real sweet spot to be in. As you get closer to 3%, which is a long ways off at this point, then the Fed is probably be closer to neutral, between 3% and 4%. One other comment for those who are interested in the equity market, this is quite a good mix still for the equity market, even though the Fed's poised to raise rates, and that could induce some volatility. With wages growing so slowly, you're not seeing unit labor costs skyrocket. That traditionally has actually brought an end to a bull equity market. So as long as wages are below 3%, that's still a pretty rosy picture for corporations.
Yeah, and in that sense, I think one of the elements to highlight is productivity, because we are going to see less growth in hours, but still strong growth in output and hence productivity gains, and that will limit to some extent unit labor costs from rising too fast. So yes, you're going to get some boost from stronger wage growth, but that will be offset by stronger productivity growth. So that's also important to highlight for the U.S. economy. That basically concludes, that was the last question, that concludes our U.S. Economic Outlook webinar. We look forward to seeing any further questions. If you have them, please don't hesitate to send them. You have our email addresses there, and we'll speak to you in a few months. Thank you very much. Bye-bye.